Hello, this is a weekly podcast dedicated to providing insights into the investment strategies of average Indian investors. Today, we're taking a deep dive into a category that's become quite popular for many of you, Flexi Cap funds. Now, we've definitely touched on these before. In fact, there's a previous video on our YouTube channel covering the basics if you'd like to check that out. But based on the material you've shared with us, today we're going deeper, really looking at specific funds and their, unique characteristics.
That's right. And just as a quick refresher, at its core, a Flexi Cap fund is an equity mutual fund. The main thing is freedom for the fund manager. Significant freedom.
Freedom in what sense?
Well, unlike categories with really strict rules like multi-cap funds, where they have to invest, say, at least 25% in large, mid, and small caps each.
Right, those fixed buckets.
Exactly. A flexi-cap manager doesn't have those fixed restrictions. They can shift money across large, mid, small-cap stocks, even across sectors, based on what they think is best given market conditions.
Okay, so it really hinges on the manager's skill and their market view at the time.
Absolutely. And that's the key thing, right? This flexibility means the manager's judgment is crucial. It creates the potential for maybe higher returns because they can hunt for opportunities anywhere. But it also means the potential risk profile can change compared to, say, a pure large cap fund or even a multi-cap sometimes.
So potentially more reward, but you're relying heavily on that manager.
Precisely. The goal is generally long-term growth, and it offers you built-in diversification across different market segments and industries.
All right, let's dig into the specifics then. The sources seem to compare some well-known funds.
Yes, they do. The material gives us a good comparison, especially between two big names often discussed together, Parag Parikh Flexi Cap Fund and HDFC Flexi Cap Fund.
Okay, let's start with Parag Parikh. What's the story there? What's their investment style?
So the sources paint Parag Parikh, managed by folks like Rajiv Thakur and Rukuntara Chandani for the domestic part, as having a strong value investing philosophy.
Value investing, like Warren Buffett style?
Kind of, yeah, influenced by that school of thought. They're looking for fundamentally sound companies. Businesses they think are solid, but which they believe the market is currently pricing too low, undervaluing.
Okay, so quality companies bought cheap, essentially. What do they look for?
Things like low debt levels, good return on equity, companies that actually pay out dividends, that sort of fundamental strength.
And how's the fund structured? Any unique features?
Yes, a really key point highlighted is the international diversification. Besides Indian stocks, the fund invests in foreign equities too. You'll often see big U.S. tech names in their portfolio.
Ah, okay, so not just Indian markets. That's quite different.
It really is, especially in this category. Now, within their Indian holdings, they tend to lean towards large cap stocks. But another interesting structural thing is they often hold a significant chunk in cash, sometimes, 16, 17%.
16 or 17% of cash? That seems high. Why do they do that?
Well, it's a strategic choice. That cash isn't generating equity returns, obviously. But it gives the managers dry powder, flexibility, the ability to jump on those undervalued opportunities when they see them, especially, say, during market dips or corrections.
Got it. So it's about being ready to buy when prices are attractive. How does this whole approach, value, foreign stocks, cash holding, translate into performance?
This is where it gets really interesting, looking at the data. Over the long haul, think 5, 7, 10 years, the fund has shown strong returns. It often ranks quite well.
Okay, good long-term track record.
Yes. But the sources point out in shorter periods, especially when the market is really, really bullish, like parts of the last couple of years.
When everything's just going straight up.
Exactly. In those phases, it hasn't always been the #1 performer. That cash holding can act as a drag when the market's soaring, and a pure value style sometimes lags behind growth or momentum strategies in those specific times.
Right, holding cash hurts when stocks are flying.
But here's the flip side, and it's a critical point from the sources: how it behaves when the market falls. Its downside capture ratio is notably low. The data shows it tends to fall significantly less than the benchmark index and many of its peers during market corrections.
So it protects capital better on the way down.
That seems to be the pattern. Its overall volatility, its sensitivity to market swings, what they call beta, is also generally lower. So the strategy appears to prioritize capital preservation during tough times.
Okay, fascinating. So Parag value international exposure, cash for opportunities, and a focus on cushioning falls, even if it means missing some peak rally performance. Now, how does the HDFC Flexi Cap Fund compare? What's their strategy?
Right, switching to HDFC Flexi Cap, managed by someone like Roshi Jain. The sources generally describe their approach as growth at a reasonable price, JRP.
GRP, so not pure value, not pure growth.
Exactly. It's a bit of a blend. They're looking for companies with solid growth prospects, but they're disciplined about the price they're willing to pay. They don't want to chase growth at any cost. They also explicitly consider things like corporate governance and ESG factors, environmental, social governance.
Okay, so growth potential, but with a valuation check, plus governance aspects. How is their portfolio structured?
Structurally, it's quite different from Parag Parikh. The sources show HDFC Flexi Cap focuses its equity investments primarily within India.
No significant foreign holdings like Parag Parikh.
Not in the same way, no. Their portfolio has big chunks in sectors like banking, automobiles, pharmaceuticals within India. And while it also has a lot of large cap exposure, it distinctively holds a portion in small cap stocks too, maybe around 12 or 13% according to the material.
Ah, okay, so Indian focus, Jurco P style, and includes a slice of small caps. How has its performance been?
Well, HDFC Flexi Cap has also put up good numbers over various time frames, typically beating its benchmark and the category average. What's quite interesting, based on the analysis, is that for a long time its performance relative to the benchmark was, pretty similar. But starting around mid-2022, it really began to pull ahead quite significantly.
It's a strong recent outperformance.
Yes, that's what the data suggests. And when you look at risk-adjusted returns using metrics like the Sharpe ratio or the Sortino ratio.
Can you quickly explain those?
Sure. Simply put, the Sharpe ratio measures the return you get for the total amount of risk you took. Higher is better. The Sortino ratio is similar, but it only focuses on the downside risk, the bad volatility. Again, higher is better. And the data shows HDFC FlexiCap scoring higher on these metrics compared to Parag Parikh, suggesting it generated better returns relative to the risk involved, especially when focusing just on the downside risk via Sortino.
So better bang for your buck in terms of risk, according to those ratios.
That's what those numbers imply, yes. Now, looking at market phases.
Right. How does it do in bull versus bear compared to Parag Parikh?
In bull markets, HDFC's upside capture ratio is higher. It tends to capture more of the market's gains when things are going up compared to Parag Parikh.
So it rides the wave higher.
It seems to, based on the history. However, likely due to factors like that small cap exposure and maybe different cash levels or overall strategy, it also tends to fall more than Parag Parikh during market corrections, although often still less than the broader market index itself.
Okay, so HFC, Indian focus, GARP, some small caps, strong recent risk-adjusted returns, captures more upside, but potentially falls a bit harder than Parag Parikh in downturns.
Yeah.
We have these two quite distinct approaches. Does the material mention any other types of flexi cap funds briefly?
Yes, it touches on a couple of others just to illustrate the variety. For instance, it mentions the Quant Flexi Cap Fund. This one apparently delivered absolutely stellar, phenomenal returns, especially in that strong bull run after 2020.
Wow, really high returns.
Yeah, but funds using momentum or quantitative models like that can be, well, quite aggressive. They might do incredibly well when the market trend is strong in one direction, but they're often seen as carrying higher risk if market conditions change suddenly.
High octane, high risk potential.
Yeah.
Any others mentioned?
Just briefly, one analysis highlighted the JM Flexi Cap Fund for having strong 3-year rolling returns combined with relatively contained drawdowns during that specific period. So another flavor again?
Right. So many different ways managers use this flexibility. Putting it all together.
Yeah.
What does this mean for you listening right now, trying to figure out flexi caps? How should you approach choosing or maybe using these funds?
That's a great question, and the sources offer a really practical perspective here. First, there's the question of whether you should even bother trying to pick individual large, mid, and small cap funds yourself.
Versus just using a flexi cap fund.
Exactly. The argument for flexi caps is pretty strong. The manager does all the shifting between market caps for you, reacting to the market. And crucially, all that buying and selling inside the fund. You don't pay capital gains tax on it.
Ah, the tax efficiency point. That's huge. If I sell my small cap fund to buy more large cap, I might owe tax.
Precisely. That internal rebalancing within the flexi cap is tax-free for you, the investor. The sources suggest that even if you actively manage your own mix of cap-specific funds, after considering the taxes you'd pay on rebalancing, plus maybe advisor fees, you might only end up slightly ahead of just holding a good flexi cap fund, or even just the category average return return.
So the convenience and tax efficiency are major plus points for flexi caps.
They really are. Now, when you're choosing between specific funds like the Parag Parikh and HDC ones we discussed, it really comes down to your personal comfort zone with risk and what your financial goals are, right?
How?
Well, are you the kind of investor who's okay with maybe not capturing every last bit of upside in a roaring bull market in exchange for potentially better protection when things turn down? If so, maybe Parag Parikh's style aligns better. Or do you prioritize capturing more of the market's gains, and are you comfortable with potentially larger swings, maybe favoring a fund like HDFC that's shown strong recent performance and risk-adjusted metrics?
It's about matching the fund's behavior to your own temperament.
Perfectly put. And here's another nugget from the sources that's quite revealing for diversification. The analysis showed that Parag Parikh and HDFC Flexi Cap funds actually have quite a low portfolio overlap. They hold a lot of different stocks from each other.
Oh, interesting. So they aren't just slight variations of the same thing.
Not at all. The overlap was suggested to be around maybe 32% or so. This low overlap means their investment styles and stock selections are genuinely different. And this suggests that actually holding both funds in your portfolio could provide really good diversification. You'd be blending two different successful approaches and sets of holdings.
So instead of picking just one, combining them could be a smart strategy for diversification within the flexi cap space itself.
It's certainly something the low overlap data points towards as a potentially sensible approach for spreading risk and capturing different market opportunities. So as you reflect on all this for your own investments, maybe ponder this question. Over the long run, what defines the best fund for you? Is it the one that hits the highest highs during the good times? Or is it the one that helps you lose the least sleep by managing the falls more effectively? Really think about which approach truly aligns with your own peace of mind for the long investment journey ahead.
That was a deep dive into the world of flexi cap funds. You can explore further episodes of Your Average Indian Investor on YouTube or Spotify. Kindly like, share, and subscribe to our content if you find it valuable.